All right, today's Tuesday Tidbit is how are interest rates determined? And there's actually two questions kind of buried in that one question. Let's start with the larger question of how are interest rates changing day to day. Now, those are all established by the investor. Okay, so the biggest investor with regards to mortgages are Fannie Mae and Freddie Mac. They are government-sponsored enterprises behind mortgages. They will sell those mortgages. So they bundle the pieces of paper up behind the loan and they sell them on a secondary market. Whatever they trade for, whatever they sell for, is what's going to establish what the rates are going to be that day. And rates will literally change Monday through Friday. Why Monday through Friday? Because that's when the markets are open. So how rates perform is purely based, at least in big part, due to Fannie Mae and Freddie Mac selling those coupons. What are the mortgages being sold for that day? That's going to kind of determine what rates are going to be like today and beyond. So truly supply and demand. Now, setting that big piece aside, how are interest rates determined on a more kind of minuscule level, on a more one-on-one level, borrower level? Well, that's a great question. So what you plan on doing with the property is going to have a large effect on interest rates. Primary residences have better rates than second homes or investment properties. So your occupancy has an effect. The type of property has an effect. Single family homes and townhomes are going to have better rates than a condo unless you put 25% down, and then they're all going to be the same. Credit score has a big effect on interest rates. Income level has an effect on interest rates. If you make under the area median income and you're a first-time home buyer, they don't care about your credit score so long as it passes their requirements, their basic requirements. Everybody's going to be kind of getting the same rate at that point. So they will not punish you for a lower credit score so long as the credit score meets their basic threshold and you make under the area median income. So income has an effect on it. Loan to value has an effect on it. Setting the previous example aside, if you put 3% down versus 25% down, you're going to have a higher rate. So those are all the things that impact the interest rate on a consumer level, on a borrower level, as well as kind of the more big scope, which is what moves rates on a day-to-day basis. Hope that helps them. Thanks.